All right. Good afternoon or late morning, everyone. This is Rich Swerbinski with the Mortgage Collaborative here once again for the last week in Mortgage Today, like we are every Tuesday at 2 o'clock p.m. Eastern, our weekly whirlwind through all the latest happenings in the mortgage industry. Each week, I hand select one of our lender members to be my co-pilot in that conversation. And back again is the CEO and president of Megastar Financial Holdings, Anita Padilla-Fitzgerald. Anita, thanks for joining me again.
Absolutely.
All right, so no shortage of stuff to discuss this week with the election, I think, kind of in the rear view. Who knows? But it appears we're headed for a change in the White House. Certainly a number of different things related to our industry and the housing industry that could be impacted and affected by that. And I want to take the beginning of today's conversation to just touch on a few of those things for all of our listeners in attendance. Any comments, questions, thoughts, please don't feel like you have to wait till the end. Go ahead and use the chat or the Q&A function here on Zoom, and we'll voice those aloud and incorporate them into the conversation. So, Anita, let's start with the GSEs, Fannie and Freddie. Obviously, under the Trump administration, we're on a path towards exiting conservatorship under the directorship of Mark Calabria. Certainly under a Biden administration, Calabria, not long for the world. Conventional wisdom is that path towards exiting conservatorship likely stalled. GSEs would most likely stay under government conservatorship. Would love to know your thoughts on the matter.
Well, my thoughts on the matter is the Biden administration hasn't specifically, given their directive with regard to the agencies and government conservatorship versus privatization. But, thoughts to ponder are, as an industry, what that really means with regard to the agencies, and if they were to privatize, if they were to remain under the government conservatorship. Some people have talked about them becoming a utility. So in the privatization sector, what we have read or what we've heard is that they need to raise $234 billion to be in a position that would make them equal to other financial institutions with regard to reserves in their balance sheet. In doing so, the question is posed, what happens to interest rates? The agencies will need to be able to raise those funds either, and are they going to increase interest rates? So some projections that I've read is that in order to improve their returns, they need to improve them anywhere from 20 to 40%, and that would reflect in the market somewhere in the neighborhood of 10 to 20, 30 basis points with regard to interest rates. So that's something I think that we need to look at. If they stay under government conservatorship, they wouldn't have the need to raise those funds. So really, what happens to the market? Will the market be more consistent as we've been traditionally and following, a certain algorithm as far as establishing interest rates? So privatization, we need to think about G-fees and other loan-level price adjusters that we might be faced with and increase in interest rate. I think under the government conservatorship, Biden has talked about his first-time home buyers tax credit and their desire to help home ownership and get more people, working toward owning a home. As we all know, owning a home is a great path to wealth. So his proposals, from what I've seen, and there's not really been anything defined as far as the proposals are concerned, will help young borrowers who haven't otherwise been able to save, and of course, minority buyers in that demographic is usually lower income, and their ability to save help some of those type of people get into homes. The subject of the utility is interesting because with the utility, you do have, from what I understand, and I'm not an expert, but they do have a protocol with regard to rate of return being set. So we wouldn't see things happening like we saw with the FHFA implementing a loan level price adjuster basically overnight, costing mortgage owners millions and millions of dollars. As we know, the CFPB single authority was ruled by the Supreme Court, is now saying that the President of the United States can fire that single authority, whereby prior to that, the single authority was able to make decisions. The FHFA is now being challenged, and I believe the Supreme Court will be hearing that challenge in December as having a single authority. But that would be an example of utility versus I've never been able to do that very well, the FHFA being able to implement like they did with that adverse market adjustment that we saw. So those are some kind of high-level comments. Any questions? Otherwise, I can keep going.
Yeah, no, as you noted, I mean, so much to unpack here. It's funny because the lead up to the election, almost no talk about housing issues. Yet we're starting to see right now, and because it's been 4 years, a change in the White House, the changes it can mean to our industry. Starting with Fannie and Freddie, I think those that are for Fannie and Freddie leaving conservatorship, the reasons are obvious. You go back to the mortgage meltdown in 07 and 08, the government being on the hook for just billions of dollars in losses on non-payments, the government having to bail out Fannie and Freddie. That ended up being an intensely profitable bailout for the federal government, still is to this day. One of the things I don't think that's talked about enough about privatizing Fannie and Freddie, or deprivatizing Fannie and Freddie, is they're pumping billions of dollars in profits into the federal government right now. As we all know, any kind of revenue spigot that big, it's tough to turn off. There's things that would have to be adjusted with that. But I think what you noted at the beginning is my biggest fear of the agencies being taken out of conservatorship, and that's what could happen to interest rates. The primary reason interest rates are so low, one, the Fed is obviously buying the living hell out of the MBS market, but for non-Fed buyers, that implicit government backstop and guarantee on the bonds that are formed when companies like Megastar sell loans to the agencies, that makes those bonds more attractive. It makes investors pay higher yields for them and lowers interest rates in the process. So, that certainly was one of my fears. Had Trump won and had the GSEs stayed down that path, it could have been very disruptive to the interest rate market and the mortgage market in general. You look at all the benefit borrowers are getting right now from refinancing and lowering their payments. People able to buy homes now because of rates being as low as they are. You bump rates up to 4.25%. Think of all those people that have refinanced that wouldn't have been able to, people that would not have been able to buy homes that otherwise would have been.
Yeah, and I asked myself really as a mortgage banker, my why. So what's your why? Why do you want the agencies to privatize? And how does that help us as an industry? So if they are under the government the way they are today, how does that help us as an industry? If they become a utility, how does that help us as an industry? And then ask myself the same question, taking off my business owner hat and putting on, my hat as an American citizen. And, how do those variables help me? And, I haven't done a ton of study on the utility, but, I think the utility it's interesting, right? So utilities can be public or private. And I think that's something that I'm sure the MBA is looking at. But as members of the MBA and members of the Mortgage Collaborative, we have a voice, and we need to make sure that We're expressing our voice and understanding what it is we're voicing and what we're saying. So, it really goes back to the why. So why do we want them to privatize? They're going to have to come up with the money. To your point, Rich, it's going to be a tough pill to swallow because the government has had, billions of dollars pumped in. But we also have to look at the future. I mean, we're dealing with COVID. Look at all of the people who have gone into forbearance and all the renters that have gone into forbearance. So you start with the homeowners who have gone into forbearance. When they come out of forbearance, what will happen? So they'll either go ahead and modify and add that balance to the back end of their mortgage, right, and move on. Some of them will continue to make their payments. Hopefully they will. We have what we're thinking is the second wave of COVID with these spikes. We don't know what's going to happen to furloughs and companies. As we all know, across the country, a lot of these restaurants are suffering. They were at 50% capacity. I know the states that we operate in, they've gone back to 25% capacity. So all of those things, matter. Your event that was canceled, hotels, people who park cars, all of those industries. So you look at the renters who aren't paying rent to the people who own those properties today. What's going to happen? So just like the mortgage owners aren't able to write a check for the payments that they missed, 3 months, 4 months, 5 months, 6 months, 12 months, do we think that renters are going to be able to make up those rent payments and fees and penalties? Maybe, maybe not. Maybe they just decide to move. So then the people who own those rental properties are out that money. My point is that what's going to happen to the agencies when all of these loans, if these loans default, right? So it goes back to the very beginning when we started talking with the money that they need to raise to have on their balance sheet so they can get through these type of hurdles. So the timing, timing is everything. So here we sit, we know that people can still qualify for COVID forbearance through the end of the year, but we have next year, we have the winter to get through. So, I guess it's kind of premature to be talking about what the Biden administration is going to do, because I think there's a lot to be seen in the next, 6 to 12 months with how we fare out of and we're not out of COVID, right? So, there's still a lot to be seen.
Absolutely. Yeah. Still so much unknown as it relates to just employment and performance of loans and forbearance that could greatly affect all these things we're talking about and move them completely to the back burner. I am with Anita Padilla-Fitzgerald, the president and CEO of Megastar Financial, leading independent mortgage banking company, one of our members based out of Denver, Colorado. We're talking about potential changes to the mortgage industry as we head into the latter part of 2020 and into 2021. Any questions that anybody in attendance has for myself, Anita, please feel free to pump them into the chat, Q&A. We'll be happy to voice them aloud. Anita, let's turn our attention to the CFPB. So I think, if Calabria is the first person that's gone, the second person is probably Kathy Kraninger, the head of the CFPB. Trump appointed. A Supreme Court ruled this past summer that the president has the authority to remove the director from that position with no other sort of congressional approval. You have to assume that Joe Biden would do that, assuming he takes office on January 20. One of the names that's being rumored as a replacement for Kraninger is Chris Peterson, who was a special advisor to Richard Cordray under the Obama CFPB. If that, some other names have been thrown about that are, they're very liberal, very consumer protection oriented names. So I guess let's start with that. Now, while the president can dismiss the director of the CFPB, the new appointee still has to be approved through the Senate. As we all know, the Senate still hangs in the balance. Republicans still hold a 50 to 48 edge. With a couple seats in Georgia still on the line. So, let's harken back to, 6 or 7 years ago, my last job as a lender before taking this role. One of the last things I was tasked with was unwinding all of our marketing service agreements because of the bank I worked for and their fear of, potential RESPA implications of those types of arrangements. Would love to hear your thoughts just on a potential change at the head of CFPB and as the CEO of a large independent mortgage banking firm. What thoughts go through your head as that potentially looms?
So, for me, I go back to what I said earlier is, what's my concern? What's my why? So, what's my concern if Fannie and Freddie privatize? What concerns do I have as a business owner, and what concerns do I have as a citizen? Same thing with the CFPB. So I think a major concern that the industry had, and when I put on my business owner hat, was rule by enforcement. So as we all know, that when Trump replaced and put Kraninger in place, that we had, less rule by enforcement. So her position was more pro-business than it was pro-consumer. However, as we also know, that single entity was dismantled. So now what we have is potentially, the Biden administration put somebody in place. There have been names. The name I heard was Katie Porter. But with that said, they don't have the power that they had, but they do have the ability to lead and interpret. To your point, we're still going to have more of a Republican side, so there's still going to have to be some balance in the middle. But as far as the CFPB is concerned, one of the concerns I had, and I had heard or read somewhere, I couldn't tell you where, that, the Trump administration was thinking of removing the skin in the game rule. And, to me, I just about crawled out of my skin, because it's my opinion, my humble opinion, but what do I know, that I think credit is in a pretty good spot right now. People who should own homes own homes. And to go back and open the market again to people who aren't really qualified and falsely inflate real estate values and have people just purely speculating and buying homes literally brought our country to our knee. So when I look at the CFPB rules, did I like the LO comp rule, and was implementation a pain? It was horrible. But as a consumer, I think it was good. Why should I be able, as I'm not a licensed loan officer, but if I were, and just even having licensed loan officers, right? You didn't even have licensed loan officers. What gives them the right to charge one person 3 points and another person 1? And what gives Wall Street the right to go out and market private mortgage backs with no skin in the game with regard to loss, and then incent a loan officer by paying them a higher commission to sell a more risky product? So the 3-day rule, why shouldn't a consumer get their figures 3 days ahead of time? They should. So to me, again, with the Biden administration coming in, I don't see a lot of change. I see that you may get somebody who's more pro-consumer, but then we have the other side who will more than likely equalize. So I'm not overly concerned about it. I don't see it as a really big change, but I'm always interested to hear people's why, because I don't know everything, and sometimes people tell me their why, and it makes a lot of sense, and maybe something I haven't thought about.
Rich Swerbinsky with the Mortgage Collaborative here with Megastar Financial President and CEO Anita Padilla-Fitzgerald, talking about potential changes to the mortgage industry. A couple of the things I want to touch on there, Anita. Before I do, had a question come in. Rob Krisman, I think some people may know that name. What stance is Megastar taking with work from home versus asking employees to return to the office?
First, hi, Rob. How are you? Long time. Our position has been that I have really just let people make their own call, because I don't, as an employer, want to debate COVID. And if people are comfortable and they don't have an underlying condition, we have allowed them to come back to work, but we haven't mandated that they have to come back to work, with the exception of certain positions that require that they be in the office to do their job. So, but for the most part, we're allowing people to work from home. We're a fully cloud-based company, so it really hasn't been an issue for us from a productivity or quality perspective. It's worked for us, very well.
Thanks, Anita. Thanks, Rob. And that blur you hear in the background is my French bulldog snoring. So just hopefully it's not too disruptive. Some other items, Anita, that I'm just going to throw out there at you that are being bandied about as things we could see from a Biden administration. First-time home buyer tax credit. We saw Obama do something similar about a year or so into his term that had some positive impact. And I want to say it was one of the first couple springs that he was in office as it related to purchase activity. Student loan forgiveness clearly could have a big impact with first-time home buyers that otherwise may not be able to buy a home. Anything there that is of particular interest to you and that you'd like to see happen for the industry?
Well, a couple of things. One, before we get off the CFPB, one thing I think that as mortgage owners we do need to be aware of is how the CFPB is going to look at consumer complaints with regard to the servicing. So I do think that we need to have a strong voice there. And just like the meltdown and just like what we've just gone through with like drinking through a fire hose, the servicers have a lot to deal with. And as an industry, I think we need to be strong in our voice in supporting the servicers with regard to these consumers. The consumers don't really understand that we're not like making up these rules. We're just following rules that have been issued to us. So they seem to think that we are private banks with a portfolio and can basically do anything we want, when in reality, we're just following a directive. But I would urge our members, to make sure that we have our voice heard with regard to the servicing piece, because I do think that's going to be a challenge, and probably it's going to be more pro-consumer from a Biden perspective than it would have been from a Republican perspective, which would have been maybe a bit more business, more pro. But I think as long as we help our legislation understand and our government understand what we're dealing with, that we might have a better outcome. As to the first-time home buyers credit, Rich, I'm a very consumer-friendly person, and I think whatever we can do to help more people get in homes, as I said earlier, it's the greatest path to wealth. However, I don't think enough has really been said with regard to how the program's going to work. What I know is they can get a credit of up to $15,000 if they're married, $7,500 if they're single, to first-time homeowners, and that the proposal will cost about $25 billion annually. So, both as a mortgage banker and a citizen, I think that a home buyer credit would be a good thing. Some people have tried to, or have, I believe, said, or how I heard it, was it would replace the mortgage interest deduction, but that's not what I understand. My understanding is it would be in addition to help people get into homes.
Thanks, Anita. And you're in Colorado, affordable housing units, some talk that the Biden administration, I believe it was in his written plan on his website, would invest some money annually into the construction of affordable housing units. At least where I am in Ohio, it is an issue. I mean, if you are a first-time home buyer, that wants to buy a $150,000 house here in Ohio, there is like nothing. All the new homes that are being built are, $400,000 and up, which where I'm at in Cleveland is a lot for a house. I think there's just been a lot written and a lot said about this issue in general, some going as far as to call it an affordable housing crisis in America, that the housing stock that becomes dilapidated and raised and knocked down each year, they're not being replaced with units that are affordable for first-time home buyers. Any thoughts on the affordable housing issue in America and any potential, government aided solutions that could help things there?
Yeah, for us, and what I know, same situation. If people are trying to buy in Denver Metro, but I think cities like Denver who have put in rails where you can take a train, that's really people's options. So I've heard about these micro units that are being built that are like 5 to 600 square feet. Some of them luxury with granite and all of this kind of stuff. I sit there and I think to myself, that's not even logical, because I get that these young people maybe want to live in town and have access to bars and all of that kind of stuff. But how sustainable is a 600 square foot house with granite? They're probably going to raise a family, get pets, and it just doesn't work on a long-term basis. But, the infrastructure, if you can get on a train and travel outside of the Metroplex and find a more affordable home. I've also heard about, I was at a Fannie Mae roundtable, obviously over a year ago, and talking about some of the modular housing and that kind of being a newer wave. But, that is going to depend on the quality of the homes that are being built and, the long-term sustainability. But to your point, I don't know. The only thing I've heard anybody speak of, which was actually our governor in Colorado, said, people just have to move farther away. And if the infrastructure is there for them to take a train, and, to Rob's point earlier, with people working from home, I think people are just going to have to spread out and, find homes that are not maybe where they traditionally want it to be.
It's Anita. Rich Swerbinsky with the Mortgage Collaborative. Have a couple minutes left with Megastar Financial President and CEO Anita Padilla-Fitzgerald. And before we depart, Anita, I got to get your thoughts just on home prices and home values in general. Skyrocketing. I believe the latest Case-Shiller index, like year over year in a lot of markets, up 20%. Home values. If you're a current homeowner and you're building equity, certainly a good thing. If you are a first-time home buyer, once again, or someone looking to get in at the bottom end of the market, maybe not as great. And also maybe some negative long-term potential impacts. You hear the world housing bubble, and we all remember, what has happened in the industry in the past as it relates to values. Any thoughts on just the explosion, is not even too strong of a word, of home values these last couple of years?
Honestly, I've thought about that. I've read on it, and I don't really know what to think, right? So when COVID hit, you would have thought maybe the opposite. So I think back to the work from home model. So people started, I guess, spreading out and moving into different places, and depending on what part of the country you live in. Are people looking to live in a high-rise condo, or are they looking, more for a single-family home? So maybe people are looking at their homes as places to work and spend more time and want more space. So people are buying and selling houses. I really find it just quite frankly fascinating to see what's going on around the country. I own property in Denver. I own property in Vail. I own property in Park City, Utah. I own property in Pebble Beach, California, and all of those places. So you look at Park City, Utah, and their market, their luxury market in particular, has just gone up. Where you look at Pebble Beach, California, it's gone down. You look at, the Colorado Metroplex, you can't find a house, a starter home for $1 million. So it's just, the market's just everywhere, and honestly, I don't really know what to think. What are your thoughts?
You know, you could go one of two ways. I mean, certainly there's the bubble fears, right? That what we're seeing now is overblown and artificial because of just a lot of underlying factors that contribute to the inventory issue that's driving this ultimately. There's just not enough homes. The demand is greatly higher than the supply right now. It's pushing values up. On the other hand, the market could be correcting. You know, I mean, the value of a home right now, for all the reasons you mentioned, people working from home, everything that the country and the world has been through these last 9 months, people place more value in their home. People want larger homes. They're there more. A trend that certainly will reverse a little bit, but maybe not entirely, God willing, when we get out the other end of this pandemic. So, you know, like most things, I think the reality is probably somewhere in the middle, that we are seeing a correction to the housing market, that if you did buy a home 4 or 5 years ago, it was likely a great time to buy a house because of everything going on right now. Even if the market corrects, that, you know, you're going to see your home continue to build equity, certainly not at the pace we've seen this last year or two, but more than historical standards. But, you know, if you're buying a house like today or next spring, you know, I think your expectations for the appreciation of that value, it should not be in line with what we've seen the last couple of years.
I do think you made a great point with the supply and demand, right? So you don't see as much supply because, you know, a lot of people are hunkering down. But then you have the demand for people who are thinking, you know, I want a bigger house, or I now can go work in the mountains where I've always wanted to work, or I can go work out on a farm where I've always wanted to be, or I can get a bigger house that's an hour away from where I was driving because I can now work from home. So, you know, that's definitely a part of it. But to your point, the underlying issue is, you know, what's the underlying issue? And all I can think of is people are putting more value in their homes, and they're figuring out in their life that I don't have to drive to downtown Denver every day. I can go live an hour away and have a bigger home with a yard, and that's what I want to do. And then you have the other side of people saying, well, I'm not going to sell my house. You know, I'm happy I have a house, and here's where I want to be.
Yeah, absolutely. I'm not smart enough to like figure out the mechanics on this, but you know, ultimately, I do think that a big part of the solution could be in, you know, finding a way, if it's tax credits or subsidies to home builders to build lower priced homes. I mean, you know, just the home builders I know, the mechanics on it just makes no sense for a home builder to build a house under $350,000, no matter what part of the country you're in, between the cost of lumber, the cost of regulation, the cost of all the different third parties that are involved in the and contractors in the home building process. It's no mystery why home builders are only building homes above a certain level. That's not worth their time and energy from the profit they'd make off it. So, you know, of all the things I've seen proposed from the Biden administration, and they don't go into great detail, you know, some sort of government assistance or aid to help create more affordable housing stock, I do think is something that would be a good thing for our industry in America. So,
Yep, land, lumber, and labor.
well,
Awesome.
we are out of time, but I want to thank all of our attendees for spending some time with us. We're here every week, same time, same place, Tuesday at 2:00 Eastern. And certainly want to thank you, Anita, Padilla-Fitzgerald. Thank you very much for once again being my co-pilot here on the Last Week in Mortgage Today.
Always fun.
Thanks. Have a great afternoon, everyone. Take care.